Okay, fellow Vanguard fans, it's finally time to talk about one of your favorite dividend ETFs, none other than VYM. I don't personally hold VYM, and we'll get into those reasons, but I do think it's as stable as they come. This thing is wildly popular, for good reason, and I don't see it going anywhere anytime soon. But who is it for, and how does it stack up against the top dividend ETFs out there? That's what we're going to break down in this video. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please cash out that like button, subscribe if you haven't already, and drop me a comment below with anything that comes to mind. Quick note before we dive in, I always use Snowball Analytics or Seeking Alpha to pull the data for my deep dives in videos like this one. They're both tools that I use and love, and I have a pinned comment if you want to try either one of them out for free. You know what time it is. Let's grow. VYM Basics. Before we start crunching numbers, let's step back and look at what VYM is built to do. VYM is Vanguard's high dividend yield ETF, and its mission is to track FTSE's high dividend yield index. To make things simple, I put together a couple slides so we can walk through the methodology and see how this index screens for companies. VYM has the most interesting methodology I've come across of the dividend ETFs I've been tracking for many years. So its index rules, it seeks to track the FTSE High Dividend Yield Index. And that index begins with all US companies, small, mid, and large cap, except for that it excludes REITs. So it pays 100% qualified dividends, which I like. Now, where it gets a little weird is that it requires the company to have paid a dividend within the last 12 months of the past, which is fine. And it has to be a normal dividend. Special dividends don't count. But then it also only pulls companies that have a forecasted dividend in the coming 12 months. And then they're ranked by forward yield. So of the companies that have paid a dividend in the past 12 months, they're projected to pay one in the next 12 months, it ranks them, it sorts them by forward yield, and the top 45% are added to the index. Now, a company will remain in the index as long as it is still in the top 55%. That's the removal threshold, so it reduces turnover a little bit. And then of the holdings that it grabs, they're market cap weighted, which is fairly common for ETFs. And it's rebalanced annually, but they will remove companies quarterly if the dividends are cut. And for some quick pros and cons about that, for the pros, it gets broad, diversified exposure. A whole bunch of companies make this index, and we'll get into that here in a bit. It's very low cost, low expense ratio. We know how Vanguard rolls. And the buffer rules, as I just alluded to, reduce the turnover. It's nice that it's not dropping companies immediately after they're outside the top 45%. It gives them that 10% buffer compared to the peers. For the cons, it's a pure yield screen. There's no quality factor to the methodology. It exclusively assesses short-term yield. There's no sector caps, so things can get skewed towards financials or energy if they were popping off in the last 12 months. And it does yield lower than some of our other favorite dividend ETFs. I want to pause for a second here because this is the part where people ask why I don't own VYM myself. I'm not a big fan of an index that's built purely around estimated dividends. That approach could load you up on yield, but it doesn't always come with the quality filters that give you confidence that these companies are consistently delivering results. Now, don't get me wrong, VYM does create a nice defensive tilt, and it absolutely can help to balance out the growth side of your portfolio. But for me, there's another ETF out there that provides a steadier mix of yield and quality, and we'll dig into that comparison a little later. First, let me lay out some of the key metrics so you can see exactly how VYM stacks up. Key metrics. It's time to pull up VYM in Seeking Alpha and to walk through some of the key stats. We'll also stack it up against some of the other top dividend ETFs out there like SCHD, VIG, and DGRO to see how it holds up. All right, we're out on Seeking Alpha and I've pulled up VYM and you can see it right here. It currently trades at $140 per share. Now on the summary tab, I look primarily for two things. I look at expense ratio, and this one is a razor thin 6 basis points, so we're keeping that money in your pocket. And then I also look for assets under management, and 79 billion is a ton. So this thing is popular, it's not going anywhere, and it's popular for good reason. Popping out to the holdings breakdown. As we mentioned earlier, there are no sector caps technically, but as of right now, only financials is over 20% at 22. Technology slides in at 16%, and then you have healthcare and consumer defensive and industrials at around 12%, and then energy comes in at 8.5%, and consumer cyclical and utilities are 7 and 6 respectively. Pretty good sector balance there. And then for the top 10 holdings, and since it's by market cap and 583 companies make this bad boy, we're going to have nothing but recognizable names. And well, we have Broadcom, JP Morgan, Exxon, Walmart, Johnson & Johnson, the Home Depot, Procter & Gamble, AbbVie, Bank of America, and Chevron. So nothing new about these. But one wonderful thing about VYM that most investors love is the top 10 holdings are only 26% of the fund. That's nearly unheard of these days. The growth ones are usually over 50%. SCHD is over 40%. This is one of the areas that I believe VYM shines. Gives you some nice diversity. And now we're out here on the dividend tab, which if you've been around the channel, you understand is my favorite tab along with charting, and we'll get there. But on the dividends here, on the general scorecard, I love this thing. You can see that the yield does come in at 2.5%, so nothing crazy on the yield. Its dividend growth rate is actually down on the trailing 12 months, the 1 year CAGR is down 3% compared to a year ago. The 3-year CAGR, the compound annual growth rate, is at 3%. You're kind of flirting with inflation. The 5 years at 4%, and the 10 years at a measly 5%. SCHD is usually 10 or 11 on these. That's a big difference of these funds. But it has grown its dividend for each of the last 14 years. So it hasn't come with huge raises here, but it's consistently done it 14 years in a row. There's something to be said about that. And I usually like to quickly pull up the dividend growth chart here, and you can see that indeed it has popped up, albeit by a small amount many of these years, but each of the last 10 years is what we can view on this one. And then of course it's gone a few more than that. So we're currently from 348 to 349. Ooh, baby, it just did keep her alive last year. And now we're out here on the charting tab. We love our charting. And of course, as always, I have set it to total returns. So this is including dividends being reinvested. We're looking at the full picture here, and we're on year to date to start. Oh, and I should mention that we're pulling up VYM and SCHD, which are more defensive tilt, lower technology, higher yielding ones. And then we have some dividend growth monsters like VIG and DGRO here. And you can see that VYM is actually the champion, just barely over DGRO on the year to date. And SCHD has been abysmal, as many of us holders know, down 10% this year. So VYM's laughing all the way to the bank so far. When we zoom it out 1 year, it's a very similar picture. VYM extended its lead over the field. You can see here with SCHD at barely positive, VIG and DGRO at 11%, VYM's up there at 13%. When we zoom it out 3 years, VYM is very competitive with the dividend growth ones. It's smashing SCHD in the last 3 years, 57% to 34%. And then it's just behind VIG at 64 and DGRO at 58. So for a defensive ETF, it has outclassed its peer in the short term. And we look at 5 years and we see more of the same here. We have 107% returns for VYM. It's actually not only still crushing SCHD, which is coming in at 81%, it's ahead of VIG and DGRO, which I was unaware of, to be honest, at 5 years. That's pretty insane. VIG at 89 and DGRO at 97. So this 107 looking pretty darn good. And as we scooch it out for 10 years, it is darn near caught SCHD in that time frame. Wow, SCHD SCHD has fallen because this bad boy beat the market. VU in its first 11 years, it's only up 209 to VYM's 201. Pretty close there. And then these growth guys get away from the pack a little, and we expect that because of technology. I mean, it's been a crazy growth run. Of course, defensive ones, especially SCHD, which is the lowest on tech, is going to struggle a little. But we have VIG taking the crown, 250 compared to DGRO's 247. These guys are always going back and forth. It's been fun to see over the years. So VYM, it's funny, historically, before the last few years, SCHD was actually slightly ahead of these two, and VYM always was trailing way up the caboose. But lately, you can see that VYM's really put a dent in the lead, and it's basically tied SCHD in the last decade. In total return, we still need to talk about yield and dividend growth, and those are coming in the actual backtest here in a bit. VYM hasn't been the strongest performer historically when it comes to total returns. But with a dividend ETF, the story isn't just about beating the market on growth. It's about what role the fund plays inside your portfolio. Let's shift gears and talk about where VYM fits and whether it deserves a spot next to your growth holdings. Portfolio fit. If you've been around this channel for a while, you know that I'm a big believer in keeping a balanced portfolio in all markets. I dollar cost average into my target allocations, and that only works long-term if you're mixing value and growth in a way that complements each other. And this is where overlap really matters. If your dividend growth ETF is just mirroring your growth holdings, you're not getting the diversification when the market changes, and it will, that you think you are. I put together this fund overlap by weight. So this is properly weighted overlap, not just how many companies there are, but the actual weight to the funds. And it's one of those things that's not important until it is. Right now, we're on a massive bull run. So when you look at VIG and DGRO, you're like, who cares? We're just raking in money, baby. But eventually we will have a growth crash where VGT, QQQM, I just put the favorite growths up here, SCHG, and then the market as well, kind of a hybrid fund here, 50-50 growth value. But if you look, SCHD only has a 2% overlap with VGT, my main growth, a 5% overlap with QQQM, a 0% overlap with SCHG, and a 7% overlap with the market. But VYM, which is what this video is about, is also very respectable. It only has a 13% overlap with VGT, 17 getting a little high with QQQM, only 8 with SCHG, and 34 with the market. So you're about a third the market. Not great, because when these crash, and growth will, it always does eventually, you go down a little bit with the ship compared to SCHD. But if you look at VIG and DGRO here, just with VGT, which is 100% tech, VIG has a quarter overlap, and DGRO is right there at a fifth of the fund. With QQQM, DGRO is at 22%, and VIG is at 29%. SCHG, they're higher than their other two friends here at 18% and 28%. And then with the market VU, you're sniffing 50% at 43 and 42 respectively. That is not good. When these crash, the last thing you want is correlation. You want a counterbalance when the growth crashes. Again, it's not important until it is. After looking at the data, we see that VYM does pretty well here. It's the second best holding, just behind SCHD, but ahead of VIG and DGRO. SCHD does win that category, and every other one that matters. SCHD gives me a stronger counterbalance to growth. It screens for quality companies rather than just yield estimates. It combines a high yield with a strong dividend growth, and historically it has delivered better total returns long term. Now, it's no secret that SCHD has been in the dumps lately, but it has proven over the long run to be a steadier, more high quality choice than VYM. That said, VYM isn't a bad option by a long shot. It's usually more diversified, less top heavy, and provides a nice defensive tilt for your portfolio. Either one could be the right fit depending on your style and what you value the most in a dividend ETF. Let's get out of all the theory and put this bad boy to the test with a real back test to see how these things compare side by side. VYM versus the top dividend ETFs. I usually like to run backtests using a realistic dollar cost averaging scenario because that's how most of us invest. But when it comes to dividend ETFs, I like to switch it up and use a retirement focused scenario since retirees care a lot more about consistent cash flow. In this case, I'll be comparing VYM, VIG, and SCHD. Using these well-established ETFs gives us over 14 years of history to backtest against, which bodes well for a retirement scenario. I'm out on Portfolio Visualizer, my favorite website to run these back tests, and I am a paying member. It is a bit expensive. I feel like I always say this, but I'm still applying for an affiliate link to try to save my viewers money if you guys are interested in this, because right now I'm paying $360 per year for access to have more than 10 years of data. Ouch. But anyway, we have portfolio 1 is VYM, and you can see them down here if you want to look as I go here. Portfolio 2 is SCHD, 100%. And portfolio 3 is VIG. They're all 100%, 100%, 100%. So before we hit go, let's go to settings. What I'm doing here is I'm pulling as much data as possible. And I'm just going to give you a spoiler alert here. It's going to start at 2011 because of the age of SCHD. So from 2011 to 2025, year to date, yes, that's good for VYM. Not so much so for SCHD as we saw earlier. In this one, retirees, we are putting in 500 grand with no contributions, no cash flow. So we plopped it into these dividend payers earlier in retirement. Rebalance doesn't matter because there's only one fund. Reinvest dividends, I just change it to no because we want to live on those dividends and have fun and see how the cash flow builds up. That's one of the powers of VYM. And display income, yes. So let's hit analyze portfolio. Okay, and we can see that we are indeed pulling from the beginning of 2012 through year to date 9/22/2025. So that is now, as I think about this, just under 14 years. I believe I said over 14 years earlier. So correction there, nearly 14 years of data. Okay, and I like to start down here at performance summary. And just a reminder, dividends are not being reinvested. That is very advantageous for VIG. These ending balances were much closer with dividends reinvested because that's how I had it accidentally the first time I set this up. But we started with 500,000 each at the beginning of 2012, and without reinvesting dividends, just the price appreciation got VYM all the way up to 1,550,000, and it fell just short of SCHD by about 14,000. Pretty close battle there. That is crazy the gap this has made up. This used to look historically way better for SCHD. Fun to see actually from the competition. And then VIG, as it should with this tech boom, is at nearly $2 million. So it's definitely outperformed on the CAGR here, and we'll get into all the CAGR information down below. I'm actually surprised to see the low standard deviation of VIG. That's pretty impressive. And you can see VYM's right there at 13, and SCHD is actually higher at 13.6. And you can compare the best years are pretty close. The worst years, fairly close. VIG is a little worse, which makes sense, growth oriented. And then we don't really care too much about these ratios for risk adjusted returns here. I mean, they are fairly similar. And I would imagine, yes, of course, VIGs are going to be a little higher. VGT and QQQM are astronomically high on this kind of stuff. And this portfolio growth actually makes my point here. You can see everything's going pretty well together, and then VYM takes quite the drop. Like at this point here, VYM was only at 1.1 million to the other two's 1.4 million. So as I've been looking at this stuff for the last few years, you can imagine what this looked like, but this is all new to me, this collapse from SCHD here towards the very, very end. And VYM is just newly competing. Earlier this year, you can see that SCHD was still ahead by over $100,000. So very interesting and impressive here. And VIG is just running away with that tech boom. These annualized returns will show a similar story. VYM is the blue, SCHD is the green, and VIG is the gray. And they really did scoot together for quite a while. VYM had a nice little 16 here, a little lower in 17 on the boom years. And you'll notice usually it's a bit lower on the up years, but that makes a little more sense. They all protect their value pretty well. VIG took a 2022 hit. VU was down 18% and VGT was down down 30% this year. You can see VIG, as I was explaining on the overlap chart, caught quite a bit of the down because of the overlap. Whereas actually VYM did fantastic and SCHD did pretty solid as well. And here's where VIG's been running away. And VYM really, wow, SCHD, no wonder everyone's so mad. I think it means it's a good time to buy, but time will tell in the future. Nonetheless, this video is about VYM and it's looking very, very good in the last couple of years. And coming down here to the annualized returns, this will show how the funds themselves have performed over a variety of time frames. You can see over the full time, it's pretty close. VYM nearly 12%, SCHD just over 12, and VIG coming in with the crown at 12.6. In the last 10 years, VYM still falling a little short by about 1% from the other two. In 5 years, VYM is actually laughing all the way to the bank at nearly 14%. And SCHD is there at 11.5 to VIG's 12.1. And here on the very short time frames, wow, look at that one, SCHD. You can see VYM is beating the competition in the last year. Oh, and not quite in the last 3 years, but it's right there. So very competitive. I'm gonna have to change my narrative that VYM never competes in total returns. That was true until the last few years in regards to DGRO, SCHD, and VIG being my other members of my big four. But total returns is only part of the game. VYM's made up some ground there. Dividend growth and yield are both included when you look at portfolio income. This shows how the raises affect things over time. You could see that in 2012, it was a fairly close race, but VYM was actually the highest yielder. Same with 2013. SCHD is hanging around here, but that dividend growth you always hear about with SCHD really kind of catches up over the years. By 2019, it had passed it, and then it just sort of kept going. It sprinted by it, and to the point where in 2024, SCHD would have paid you $57,000 with 0 pennies reinvested. You get to spend every dime and have fun. To VYM's 38.6 and VIG only 31. It's one of the reasons VIG looks so shiny on that first performance summary we looked at. Of course, most of its returns are price. Granted, it has done better straight up on total returns, but you can see the huge deficit here, and this is what I care about personally, especially closer to retirement and in retirement. How much are you paying me now, and how much is that growing? Because that turns into stories like this. And for some reason, Portfolio Visualizer has not added the dividend for VYM or SCHD for the second quarter. So to be clear, they are both way ahead of VIG still. I don't know why this is still lacking that information. And the last thing I'll show here, VYM from a value perspective, its PE ratio is 19.3 right now, which is quite a bit below VU, the market, which is in the mid, maybe even high 20s. SCHD, this is why I was saying earlier, it's a pretty good buy, is under 17 PE right now. And then VIG here is at about 25, which slides in just under the market. So VIG really is a hybrid fund. It's kind of hard to consider it a quote unquote dividend ETF. You can't go wrong with any of these three funds. They all bring something to the table. That said, I think VYM and SCHD work better as value tilts in a portfolio that already has growth on the other side. VIG, meanwhile, plays more of a hybrid role, part dividend focused, part growth. At the end of the day, the key to all this is building a balanced portfolio that works for your needs and then sticking to it in all market conditions. Do that and you'll win this simple game of investing. And more importantly, you'll be the final boss of your most important resource, your time. And check out one of these two videos to continue down your path towards financial freedom. Remember, money is overrated. Freedom is not. Thanks for watching, and I will see you in the next one. Peace.